August 9th, 2007, Paris, France. A bank called BNP Paribas freezes 3 investment funds. The reason? Nobody can tell what the mortgages inside them are worth anymore. The mortgages in question came from the United States, and the story behind them started years earlier. After the dot-com crash and the September 11th attacks, the Federal Reserve cut interest rates sharply to keep the economy moving. Borrowing became cheap. Banks and mortgage lenders, hungry for growth, began pushing loans to people who would never have qualified before. These became known as subprime mortgages, loans to borrowers with weak credit, little income documentation, or no down payment at all. Lenders called some of them ninja loans. No income, no job, no assets. Countrywide Financial, the largest subprime lender in the country, built an empire on them, alongside rivals like AmeriQuest and IndyMac. Adjustable rate mortgages offered a low teaser rate for the first 2 or 3 years, then reset much higher. Lenders barely checked whether borrowers could ever afford that reset. As long as home prices kept rising, everyone assumed borrowers could simply refinance before the higher payments hit. Homeownership in the United States climbed to a record high. Television networks ran shows about flipping houses for quick profit. Real estate, for a few years, felt like a market that could not fall. Wall Street turned these mortgages into a business of its own. Investment banks bought thousands of loans, bundled them together, and sliced them into securities called mortgage-backed securities, and more complex versions called collateralized debt obligations. Some banks went a step further, creating synthetic CDOs that simply bet on the performance of other mortgage securities without owning a single real loan, multiplying the amount of money riding on the housing market many times over. Credit rating agencies, including Moody's and Standard & Poor's, stamped large portions of these bundles with the highest possible rating, AAA, the same rating given to U.S. government debt. Pension funds, insurance companies, and banks around the world bought them, believing they were safe. Investment banks themselves held enormous piles of these securities, often borrowed against 30 times over. To insure against the risk, banks increasingly turned to a financial contract called a credit default swap, essentially a bet that paid out if a bundle of mortgages failed. One insurer, AIG, sold hundreds of billions of dollars worth of these contracts, collecting premiums for years while assuming almost nobody would ever have to pay out. A small number of investors looked at the same mortgage data and reached a different conclusion. A hedge fund manager named Michael Burry spent months reading through loan documents and became convinced that huge numbers of subprime mortgages would eventually default. Starting in 2005, he paid banks to create credit default swaps he could buy, effectively betting against the housing market itself. Another investor, John Paulson, built a similar bet through his hedge fund. For years, both men paid steady premiums and watched Wall Street treat them as eccentrics for wagering against an industry that seemed unstoppable. By 2006, home prices in the United States had been rising for a decade. That year, they peaked, then began to slide. Adjustable rate mortgages started resetting to their higher payments. Borrowers who had counted on refinancing found their homes were now worth less than they owed. Defaults began climbing. In April 2007, New Century Financial, one of the largest subprime lenders in the country, filed for bankruptcy. 2 months later, in June, 2 hedge funds run by the investment bank Bear Stearns, both heavily invested in mortgage securities, collapsed, wiping out billions of dollars for their investors. Then came August 9th, when BNP Paribas froze its funds in Paris, unable to value the mortgage assets inside them. Central banks around the world responded by pumping emergency cash into the banking system. A month later, depositors at Northern Rock, a British bank that relied heavily on mortgage lending, lined up outside its branches to withdraw their money, the first bank run in Britain in over a century. Through early 2008, the losses kept surfacing. In March, Bear Stearns itself ran out of cash, as lenders refused to extend it credit overnight, after years of operating with barely any cushion against exactly this kind of run. The Federal Reserve helped arrange an emergency sale to JP Morgan Chase at a price of just $2 a share, later raised to $10. Regulators called it a rescue. Many on Wall Street called it a warning that nobody heeded. By summer 2008, Fannie Mae and Freddie Mac, the 2 government-sponsored companies that backed roughly half of all American mortgages, were themselves buckling under losses, their stock prices collapsing as investors questioned whether they could survive at all. On September 7th, the federal government placed both companies into conservatorship, effectively nationalizing them and guaranteeing trillions of dollars in mortgage debt directly. 1 week later, the crisis reached its breaking point. Lehman Brothers, a 158-year-old investment bank, had loaded up on mortgage securities and real estate investments it could not sell. Over a tense weekend at the Federal Reserve Bank of New York, regulators tried to arrange a buyer. The British bank Barclays came closest, but British regulators declined to approve the deal in time without a government guarantee, and no other buyer stepped forward. Early on September 15, 2008, Lehman Brothers filed for bankruptcy, the largest bankruptcy filing in American history, with more than $600 billion in assets. Employees carried boxes out of its Manhattan headquarters as photographers watched from the sidewalk. That same weekend, Merrill Lynch, fearing it would be next, agreed to sell itself to Bank of America. The next day, the insurance giant AIG, which had sold enormous amounts of insurance-like contracts on mortgage securities, was hours from collapse. The Federal Reserve stepped in with an emergency loan of $85 billion in exchange for nearly 80% ownership of the company. It was the largest government bailout of a single company in American history at that point. Panic spread into corners of the financial system most Americans had never heard of. The Reserve Primary Fund, a money market fund that held Lehman debt, saw its share price fall below $1, a rare event known as breaking the buck that terrified ordinary savers who assumed money market funds were as safe as a bank account. Investors pulled hundreds of billions of dollars out of similar funds within days. The market for commercial paper, the short-term loans companies rely on just to make payroll, froze almost completely, forcing the Federal Reserve to start buying it directly to keep businesses running. Markets around the world went into freefall. Credit stopped moving between banks entirely, since no institution trusted another to still be solvent by morning. In Iceland, a country of just over 300,000 people, 3 major banks that had grown to nearly 10 times the size of the national economy collapsed within days of each other, and the government eventually had to seek emergency loans from the International Monetary Fund. On September 25th, back in the United States, regulators seized Washington Mutual, a large savings bank crushed by its own subprime mortgages, and sold its assets to J.P. Morgan Chase overnight. It remains the largest bank failure in United States history. Treasury Secretary Henry Paulson and Federal Reserve Chair Ben Bernanke asked Congress for $700 billion to buy toxic mortgage assets off bank balance sheets and calm the panic. On September 29th, the House of Representatives rejected the plan. The Dow Jones Industrial Average fell nearly 778 points that day, its largest single-day point drop up to that time. Congress reversed course within days. President Bush signed the Troubled Asset Relief Program into law on October 3, 2008. Within weeks, central banks in the United States, Britain, the Eurozone, and several other countries cut interest rates together in a coordinated move rarely seen outside wartime, trying to convince the world the financial system would not be allowed to fail entirely. The damage was already done. Over the following year, unemployment in the United States climbed toward 10%. Millions of families lost their homes to foreclosure, and whole neighborhoods in places like Las Vegas, Phoenix, and parts of Florida emptied out, with foreclosure signs on lawn after lawn. Homeowners who kept their houses often owed more on their mortgage than the house itself was now worth, a condition that came to be called being underwater. Stock markets worldwide lost trillions of dollars in value. What had started as a niche corner of the mortgage market had pulled down some of the oldest institutions on Wall Street and tipped the global economy into its deepest recession since the 1930s. In the years that followed, congressional investigations picked apart what had happened. Lending standards had collapsed. Rating agencies had mislabeled risk on a massive scale. Regulators had allowed banks to pile on leverage with almost no oversight, a shift that traced back, in part, to the repeal of Depression-era banking rules a decade earlier, which had let commercial banks and investment banks merge into much larger, more tangled institutions. In 2010, Congress passed the Dodd-Frank Act, the biggest overhaul of financial regulation since the Great Depression, aimed at preventing a repeat. The $700 billion in bailout funds under TARP was eventually mostly repaid, with the government even turning a small profit on some of the bank investments, though taxpayers absorbed heavier losses elsewhere in the rescue. Almost no senior bank executive ever faced criminal charges for what happened. Angelo Mazzillo, the head of Countrywide Financial, settled civil fraud charges with regulators for tens of millions of dollars without admitting wrongdoing. Richard Fuld, the last CEO of Lehman Brothers, was never criminally charged at all. The investors who had bet against the housing market fared very differently. Michael Burry's fund earned roughly $700 million from his wager, after years of investors questioning his judgment and demanding their money back before the bet paid off. John Paulson's hedge fund made an estimated $15 billion, one of the largest single trades in financial history, built entirely on predicting the collapse everyone else had insured against. He walked away with nearly $500 million in past compensation.